Hello and welcome to another episode of the Novice to Pro series. So on this episode, we will be continuing with where we started, that is from episode 1 and 2. So today being the third episode, we will be focusing on the tradable assets. So for those who are new, I suggest that you go to the FXPesa YouTube, go through the channel with the Novice to Pro series, watch episode 1. Once you're through, move to episode 2, then you will be very much ready for this very episode. So, quick introduction. My name is Rufas Kamau, market analyst at EGM Securities, which is the company that owns the FXPesa brand. So, if you have any questions regarding the presentation, feel free to raise those questions in the live chat. And at the same time, I would like to begin by doing a mic test. So if you can hear me clearly, kindly type hi on the live chat, and these will confirm that everything is working just fine. All right, guys. So let's proceed. So in this fire series, I would like to begin by mentioning that it's designed to have 10 episodes, and it's a project that is designed to help you develop from a total beginner or from a novice all through to a professional level trader. So having mentioned the first and second episodes, today we are looking at tradable assets. So right after these, the next episode next week will be focusing on candlesticks. The other one will be market structures, trading strategies, risk management, understanding market news, building a trading system, and lastly, we'll be focusing on how to trade like a pro, having built the first 9 episodes. So let's get started right away. So the very first thing I would like to mention is that there is very many asset classes that are available for trading on the FXPesa platform. So when you decide to become a trader, sometimes you're confused, you don't know which assets to trade, which other assets not to trade. So today we'll be doing an overall outlook of all the asset classes available for trading. And also we look at the major differences between these assets and how you navigate through them. So one of the most popular products that FXPesa offers is forex trading. So this way you're able to speculate on the exchange rate of the various currencies available on the trading platform. So let's start with an example. I'll start with the pound USD currency pair. I'm adding a template here. I believe we looked at how to save a template in the previous episodes. So this is the exchange rate between the pound and the US dollar. And as you can see, there's a very nice chart here indicating the movement of the asset. So there's the current price here in blue. There's a green line and a red line indicating both my bid and my asking price. So the same prices are indicated here on the market order section. And if you ever go to the new order section, let's say you want to trade, it's the same price that you see here and also the same price that you see moving here. So what are the features of this particular asset? So if you decide to trade, when does the market open? How does the session run? And what are the specifications for this particular currency pair? So first things first is notice we are trading the GBP against the US dollar. So the bid and ask prices represented here will basically show you the exchange rate of £1 against the dollar. So I believe we covered how to read a quote, but I'm going to repeat again. So for the bid price, this is the best offer by the buyers in the market. So the way you read this is that the highest buyer in the market is willing to offer 1.20792 US dollars for one Great British pound. So on the asking price, we are looking at the lowest seller in the market. So the lowest seller in the market is offering 1.20806 US. Is offering to sell pounds at 1.20812 US dollars. So it's a very simple quote to read. One side is the highest buyer, the other one is the lowest seller, and we are always trading the base currency. So the bid price is always in the quote currency. So if I'm looking at USDJPY, then $1 is going for 0.95496 Swiss francs. So focusing on the pound, yet again, you can always right click and then go to the specification section. And this is where you see the specifics for the particular asset. So let's begin with one of the most important things in this pop-up window. And this is the market sessions. So you need to know when the assets begin trading and when they close trading. So remember, this is on Kenyan time. So the market doesn't trade on Sundays. It's completely closed. So the market will open very early on Monday, and this is around midnight. So once the market opens, it runs for 24 hours and closes at 23:59, and immediately opens at midnight Tuesday and keeps on trading for 24 hours through to Wednesday, Thursday, and Friday. And once you get to midnight on Friday, the market is closed. No trading on Saturday, no trading on Sunday, and then the market is open the following Monday. So it's important that you understand the trading sessions. So this way you will not attempt, let's say, to execute or close a trade on a weekend, because you'll not be able to do that when the market is closed. So as for swap rates, and a swap is a small fee that you pay for holding onto your trade past a trading session. So for instance, if you decide to execute a trade on Monday, let's say within the day, morning, midday, or afternoon, and you hold onto that trade past midnight, then you pay a small fee called a swap. And this is really the interest rate differential between the two currencies. So if you're trading pound USD, it's the differential between the pound and the US dollar. So the fee that you pay will be applied once on Monday. If you continue holding onto the trade between Tuesday and Wednesday, then you pay another fee. If you hold past Wednesday night, then you pay 3 times the multiple, and this is to compensate for the weekend. So 3-day swaps are applied on Wednesday. Then on Thursday, you pay once. Friday, you pay once. So if at any time you find yourself holding onto a trade between Friday and Monday, then that is often counted as 190. So if you execute a trade on Friday, hold onto that trade up until Friday the following week. Sorry, you execute a trade on Friday, you hold on to that trade up to Monday the following week. Even though there is a Saturday and Sunday in between, you only pay swap for 1 day. So the swap is applied in points. So the fee that you get to pay for your trade is applied in terms of points. And points are literally the smallest movement that a currency makes on the platform. So the swaps are specified for both the long and the short side. So if you have a buy trade, then the swap will most probably be different from the sell trade. So if you have a long trade, the swap will be indicated here. If you have a short selling trade, then the swap will be indicated here. So this way you're able to tell the amount of points that you will charge for holding the trade past midnight. Let's say you can calculate for several days, you can see the actual cost. So in most cases, it will be a very minimal cost compared to the outcome of your trade. So if let's say you're executing a trade, let's say risking $20 going for $100, and let's say that the trade takes you, let's say 1 or 2 days, then probably it will be less than $1. So it's usually a very small amount compared to the outcome of the trade. So having mentioned that, now we move on to the volume step. Volume step, this takes us back to a very interesting concept, and this is what we call standard contracts. So a standard contract is the amount that you can trade in one contract, and this contract has a size. So case in point, if let's say you are participating in just a normal vegetables market or food market, and let's say you decide to trade in eggs, you will realize that eggs are normally traded in trays. So if you trade one contract of eggs, then you are probably getting one tray of eggs. So if you move to a different market, let's say you are trading in bread, then you get your bread in crates. So the same case applies to currencies. So when you buy and sell a currency pair, you don't get to buy just $1 or $1 Canadian or £1. There is that standard contract. So one standard contract in currencies will have 100,000 units, and this is the same for all currencies available on the platform. So by specifying one full contract as your trading size, then you will be trading 100,000 units of that currency. So the minimum that you can trade is 0.01 or 1% of a contract. So when you check here and look at the volume step, you'll notice it's 0.01, meaning that if you trade the minimum, which is 0.01, if you need to take another step and trade higher, then you can add 0.01 and trade 0.02. You can trade 0.03 all the way to a maximum lot size of 150. So this basically describes the specifications for the asset you're trading. So the other key concept that is important to notice is that the currency has 5 digits. So in this case, if you look at the pricing of pound USD right here, there's 5 decimal points. So the current price being 1.20820 basically implies there's 5 decimal points. So the smallest price movement is 0.00001. So if price moves from, let's say, let's try and write this down on the chart. So I'll try to be faster here. So if price moves from 1.20806 to 1.20807, then we basically say it's 1 point movement. So I'm hoping this will be clear for everyone. So the smallest unit of the currency can move from 1.20806 to 1.20807. That is described as 1 point movement in that particular asset, in this case, the pound USD currency pair. So you can always measure the number of points that the market has moved using the small tool here called the crosshair. So for instance, if I need to check the movement today or the difference between the lowest price and the highest price, click, hold, and drag, and then check the number of points. And that is 911 points for the pound USD today. So it makes it very simple to understand price movement when you understand what 1 point means in the market. So still on this one, so still on the specification. So we have seen there's 5 digits, the contract size is 100,000 units. So the spread is the difference between the bid and asking price. It's floating, meaning that it depends on the market, keeps on changing. You can always add a spread column here. You can right click, then go to columns. Let's say you remove the daily change and add the spread. And now you can easily visualize the difference between the bid and asking price. So in this case, we are looking at a spread of 2.5, 2.0, and so on. So you will realize that different assets will have different spreads that you can use when you are trading. So remember, the spread being the difference between the bid and asking price. It's basically the difference between the green and red line. So the idea is that if, let's say, you're buying and you buy from the lowest seller, using the red line, in order for you to make a profit, you have to wait for the green price to move towards your entry point. And once it moves above that point, that's when you start making a profit. So if the spread is wider, it's not good for you. If it's closer to, if it's tighter, that is the two lines are very close to each other, then it trades to your advantage. So you buy from the lowest seller, and then if you decide to sell, then you're selling to the highest bidder. So you have to wait until the price of the highest bidder gets to your buying point. And if it goes higher than that, then that's when you start making a profit. So that being mentioned, I'll be taking questions from you guys. So if you have any questions arising from the presentation, feel free to type them in the live chat section, and I'll be responding to those questions right away. So hello, Tony, and welcome to the session. Hello, Martin, welcome to the session. Kindly adjust your mic, too much echo. Hope I can. I don't know how to do this. I've been using the same mic the same way, so nothing has changed structurally. So Forex Kenya, hello and welcome to the session. Welcome, Joseph. I like the session. Thank you for your response. So I'm not using a mic. I'm using the native microphone of my laptop, and it's the same thing I've been using in the previous sessions. So I wonder how you're getting the echo. So hello, Ryan, and welcome. So if you guys have any questions regarding the presentation, they are much welcome and happy to respond to those questions. So for now, we are focused on a currency pair and how you trade a currency pair. So we just focused on the assets available on the platform and how you trade them. So we have mentioned that the standard contract size is 100,000 units, but then the minimum you can trade is 0.01. So if you want to execute a trade and you go to new order and you check the volume section and you type 1, you will see the indication showing you that you're trading 100,000 pounds. So if this is the price of £1 and you click buy by market, then you're buying 100,000 pounds at this price. On the other hand, if you decide to go for a short selling trade and you set a volume of 1, and then you click sell by market, then you'll be selling 100,000 pounds at this price in the market. So remember, you have leverage on your side. So if let's say you decide to go for, I'll do an example here, go for a buy trade, click buy by market. So immediately you'll have a buy order in the market and see the green dotted line marking my buying price. So in this case, since I've already entered the market, you notice the details here. But then the margin requirement for the trade is a much smaller amount of money. So if you want to do the math, and I hope this will be clear for everyone. So these are quick whiteboard I can use for the math. So let's see. So I bought one contract at 1.20846. So 1.20846. So I bought one full contract, and this one full contract has 100,000 units. So in this case, the total value of my position in this case is equal to $120,846. So if you are a beginner and you just started trading, you'll start wondering, where do I get the $120,846 to buy one size of pound USD? So this is where leverage comes in. So as FXPesa, we provide you with leverage with a maximum of 1:400, meaning that you contribute $1 in every $400 worth of position. So in this case, if you take that amount and then divide by 400, so I'm doing this on my calculator. So 846 divided by 400, the result is 302.12. So if you take $120,000, 846, then you divide these by the leverage. Then the amount that you are required to have in your account, in this case, will be 302.12. So this is referred to as the margin requirement. So when you go back now to the trading platform, you'll notice that the margin requirement for the trade is 302.12. So for you to buy such a position, I know it's big, it's a huge position here, but you're not required to commit all that amount of money. You only commit a small amount of money. And now, every time the market moves, in this case by a point, then you make $1. If it goes against you by a point, then you lose $1. So you can always customize this section by right-clicking, go to your profit, and then select as points. So you'll see the number of points that the market has moved versus the amount in dollars. So in this case, you can see they are equal. So 1 point is worth $1. And that is when you are trading one full contract. So on the other hand, if you decide to make a much smaller trade, I'm going to close this one so that I can illustrate the other one. So you go to new order, and instead of trading a full contract, in this case, you decide to trade 0.01. Then if you, let's say, go for a buy market, first of all, notice that the size of the position has reduced from 100,000 units to 1,000 units, in this case, 1,000 pounds. So if you decide to go for a buy and trade again, notice that now the number of points is not equal to the amount in dollars. So now I'm down -9 points, but then it's not worth -$9. It's trading at 100 multiples down. So 8 points are worth 0.08 of $1. 6 points, 0.06, meaning that 1 point is worth 0.01 of $1. So in this case, the price movement doesn't affect me as much. So the significance of price movement, let's say by 10 points, will probably give me $0.1, and the losing side is also the same. But then if you're trading a full contract, a movement of 10 points is worth $10. So there's a big difference. So I want you to think about it this way. If you trade a very big bank, a very huge bank, in this case a full contract, and then there's a significant change in price of that bank, then you stand to make a lot of money from that bank. And if you are wrong, you're on the losing side of the trade, then you lose a lot of money. On the other hand, if you trade a very small bank and that there is a significant or a similar price movement, let's say upwards or downwards, then you can make a small amount of money, and also you can lose a small amount of money. So if you trade big, you are taking a bigger opportunity, you are taking a huge leverage. So in this case, if things go well for you, you make a lot of money. If they go badly for you, then you lose a lot of money. Trade a small bank, then the risk versus reward is much more smaller. And in this case, you might have to find a balance between trading a big bank versus a small bank. So I've just done one standard contract and the 0.01. Of course, this is not the limit. You can also do anything in between. So for instance, you can say, let's say trade 0.03, go for your trade. And now, now that we know that 1 point, when you're trading 0.01 is $0.01, then in this case, it's a multiple of 3, so $0.03 per point movement. So it's very important that you experiment with your lot size on your demo trading account or what you call a practice account. So remember, the moment you register for an account with FXPesa, you get access to a demo trading account where you can practice these ideas, try and understand what the lot size is, how it affects your trade. And once you understand the concept, then it's easier for you to transition to a live trading account. So I encourage you to do a lot of practice, try out these ideas, and once you understand them, then you'll be able to trade them on the platform. So good question. What are pips? What is the difference between a pip and a point? So when it comes to trading, I've mentioned that the smallest price movement is called a point. So every 10 points make up a pip. And this is a very simple rule. So in this case, I'll write this. So every 10 points make a pip. So it's another way of just reading. So you can choose to read, let's say, length in centimeters versus length in meters. So centimeters, in this case, would be the smaller measure. So the smaller measure in trading is points. But then every time you get 10 points, you can refer to that as a pip. So for instance, you can look at this trade and say it's down 43 points. Or sometimes you can just say it's down 4.3 pips. So just same language, trying to communicate the same message. So a pip is every 10 points. So I'm hoping that that is a clear point for everyone. So for instance, if I measure the movement, let's say from here down to here, and I identify this is 620 points, I just divide by 10 and I can tell you this is 62 pips. So a very simple way of reading price movement. So now that we are through with that part, I would like to mention that some currencies pairs will be a little bit different. And this is currency pairs that involve the JPY. So the Japanese yen is a little bit different from all other currencies, mainly because it trades at higher multiples to the US dollar. So if you look at Euro USD, it's trading very close to the US dollar, 1.01, Pound USD 1.2, USD Swiss franc 0.95. But then if you move to a JPY currency pair, like in this case, the USDJPY, then it's 134.663. So the pricing is in 3 decimal points rather than 5 decimal points. So if you look at the specification, you'll notice it's still the same. The contract size is the same. So digits is 3. So now if I move to, let's say, USDJPY, let's just open the chart. So this is the movement. This is how the asset is trading. So notice that the price has 3 decimal points. Current price is 134.658. So now, when you're trading the USDJPY, it's important to know that the point is not 0.00001. In this case, it's the smallest movement, which is 0.001. So I'll try and highlight it here. So if price, let's say, moves from 134.657 to 134.658, then this is a 1 point movement. So notice that, yes, it's 0.001, but it's also described as 1 point movement. So if it moves 10 points, then that's basically 1 pip. So if, let's say, you go to new order and you execute a trade here, let's say you're trading 0.01, and then you go for a buy by market trade. So let's close the other one. Now notice there's a small difference between when the counter currency was the US dollar and now that the counter currency is the Japanese yen. So the main reason is that your trade is being settled using Japanese yen. So remember, in this case, when you're trading USDJPY, this price is quoted in Japanese yen, meaning that $1 US is equivalent to 134.656 Japanese yen. So if you buy this currency pair, you will be buying, let's say, using Japanese yen. And then when you decide to sell, you sell in Japanese yen, so your profit is in Japanese yen. So this is calculated as 28 Japanese yen, but you have to multiply by 100 to get the real value in dollars. So that's basically how you do the conversion. So this would be 22 Japanese yen times 100, and then you convert that to dollars. And this is done in real time, so you can always see the value here. And it's very straightforward. You don't have to do the math. You just have to practice with it, understand how it works, and then you transition to your live account. So that's the main difference between JPY currency pairs and all other currency pairs. So the others, the treatment is always the same. And now we move on to other asset classes. We'll be beginning with stocks. So stocks are very basic, very simple to trade. So for instance, I'll try to show you a stock I've been focusing on, very affordable. And this is not a recommendation to trade the stock. So it's just a highlight to show you how the stock is operating. So this is a US company that deals in artificial intelligence. So it creates programs that it hires to other businesses and governments for use in their data processing systems. So currently, the share value is trading at $10.10 and 10.02. So 10.02 being the highest bid in the market, while 10.10 is the lowest offer in the market. So if you're buying, you buy from the lowest seller at 10.09. And if you're selling, then you sell to the highest bid at 10.01. So this is the current share price of Palantir. So the major difference between currencies and stocks is that the contract size is 1. So if you decide to trade one contract size, in this case, you trade one asset, then you are literally buying one share. And this makes things very simple. So no math about margin requirement and all that. So if you, let's say, click on new order, you just want to buy one share, you write one share, it will tell you it's one share of Palantir, click buy by market, and that's it. You have your one share in the market. So if the share gains by $1, you make $1. If the share loses by $1, you lose $1. So you can just check your entry price here. So this is the price at which I bought the share, 10.09. So you can even forget I executed this trade, and I can use, let's say, my phone, just check randomly on Google or any other website what's the current value of Palantir shares. And if it has gained by $5, $10, and I'll always come back, close my trade with my profit. So, and also, another key distinction is that in traditional markets, especially the Kenyan market, the Nairobi Securities Exchange, traditionally you'd be required to, let's say, do a minimum number of trades. Let's say you want to buy Safaricom shares or any other company. The minimum would be, let's say, 100 shares. So it would be a big barrier to retail traders who are looking to start small. So the beauty about this, for instance, this share is going for $10. This is about 1,000 Kenya shillings or 1,250, depending on the exchange rate. So now, if you just decide to buy one share, you can deposit money via FXPesa, buy one share tomorrow, even next week, deposit some more money, buy a couple more shares. And this way, you're able to build your investment bank by determining the number of shares that you want to buy periodically, and then keep on building that bank. So that's it with stocks. Nothing more to describe. So the first thing is that the contract size is 1. So if you look at the spread, it's floating. So everything else is similar. So smallest movement is 0.01. That is basically 1 cent. You might want to check the swap for the long and the short side. So if you have a buy and trade in this stock, so every day you hold on to that trade, you'll be paying 4.15 points. So we have seen for one share of Palantir, the price is $10.09, and the smallest price movement is 0.01, meaning that if the price makes 1 point movement, it's basically $0.01. So if you take 4.15 points, then that is $0.04. And that's a very small amount or a very small price to pay for holding onto your trade past midnight. So that's like 4 shillings on a stock that is worth about 1,250. So you'll find that most of the time, even if you're paying a small swap for holding onto your trade, the returns on that particular trade or idea might be significantly higher compared to the swap that you're paying. So the swap is cumulative. So if you keep on holding on the trade for a long period of time, then the swap can accumulate, and the longer you hold onto a trade, the higher the swap that you pay. But of course, you have seen the major difference here. So if you're on the short selling side, it's 0.85. So you basically pay 0.008 So a very minute amount for that trade. So the other key thing to notice is that the swap 3 days swap rates for stocks don't apply on Wednesday, they apply on Friday. So if you hold on to your stock trade past Friday, and then you're still holding the position on Monday, then you be paying swap for 3 days. But then for the rest of the days, Monday through Thursday, you just pay for that particular one night. So the last thing to mention is about the market sessions. So for stocks, they trade on centralized stock exchanges. So for instance, the Nairobi Securities Exchange will open for a couple of hours from morning to afternoon, and then it will close. So it's the same practice globally or worldwide. So you'll find stocks trade for a small number of small window of hours, and then it closes, and you have to wait to trade the following day. So this is in Kenyan time. So if you're trading American stocks, then the market will open at 4:30 p.m. That was about 4 hours from now. Once it opens, it will continue running up until 23, and this is 11 p.m. So the market will close at 11 p.m. There will be no further trading up until the following day at 4:30 p.m. So market opens, runs through to 11 p.m., keeps doing that on Wednesday, Thursday, and Friday, closes on Saturday and Sunday. So it's very important that you understand that the stock markets don't trade like currencies. So currency markets are decentralized, so it makes it possible for you to trade for 24 hours a day. So I'm hoping that that is clear for everyone. So there's a good question, explain about stop loss and take profit. I believe this is something we have covered in the previous session, that is the intro session. What are synthetic indices? A good question. Explain H1 and D4 and such lingo. This is good. So synthetic indices, these are indices that are developed by individual companies, and they are not listed on any exchange. So anyone can create an index, including yourself. And if you decide to create an index and it's not regulated by any market regulator, it's not publicly available for trading, it's only provided on your platform or other platforms that you work with, then in that case, it's a synthetic index. So for all those boom and crash and all that, those are synthetic indices. And the main challenge when it comes to trading them is that they are not regulated, so they can be manipulated. They are actually prone to manipulation. So if it's a market index that is public, like the CBOE volatility index or the VIX, then in that case, that is not that is regulated, so it's not prone to manipulation. So you have to make a distinction here. So if you're a fan of trading the VIX 75, that is I would call that a synthetic index. But if you have the VIX or the volatility index, and that's what we are offering at FXPesa, you're able to trade that without the fear of the market being manipulated. So volatility indices are not influenced by any physical happenings around you or around the market. But then if it's the VIX, remember it tracks the performance of the S&P 500, the volatility of the S&P 500. So you're able to study the market and create an edge for yourself by executing strategy trades in a particular direction. So good questions, keep them coming. So is it possible to set a buy stop and sell stop on the same platform with the same volume? Yes, definitely. Explain H1 and D4. So let's get to that. So this is something we have covered in a different session. So these are timeframes, and we use the timeframes to visualize the price movements. So for instance, if let's say you're trading pound USD, and you're looking at these candlesticks, the green and red bars are referred to as candlesticks. They represent the price action summaries for different periods of time. So you will notice that these summaries can be visualized from this area here when I put my cursor on a candlestick. So you'll see the open, the high, the low, and the closing price of that asset. So if you're looking at a price action, let's say for a day, you will have 24 candlesticks. So from, let's say, opening of the day here on Friday up to the closing of the day here, you notice it's saying 24 bars, meaning 24 candlesticks. So a candlestick is formed at every hour, giving you a summary of what happened within that hour. So this is what happened this hour, the next hour, the next hour, this hour, this hour, this hour, up until the end of the day, and then the next hour of the following day, the market keeps on going like that. So if you check on H4, then it's the price action summary after every 4 hours. So this is the price action candlestick for the last 4 hours, the other 4 hours, the other 4 hours, the other 4 hours, and so on. So if you use D1, then this is the price action summary for today. Friday last week, this was Thursday, Wednesday, Tuesday, Monday, and so on. So you are able to visualize the price action movement based on different time frames. So if you use a higher time frame, you are able to view a much larger outlook of what has been happening in a particular asset. So for instance, from the daily chart in pound USD, I'm able to visualize the price on the 21st of February 2022. But then if I'm on H1, that is the 1 hour chart, I'm only seeing Friday, Thursday, Wednesday, Tuesday. So the farthest I can go is in this case, 1st August 2022. So higher time frame will allow you to see more historical prices. A smaller time frame will show you only the recent information, and you use that for your analysis. So we covered that in the previous episode. So I was just highlighting that to make sure that you grab that. So remember, the focus for today is on the tradable assets. So we have focused on currencies. We have seen how you trade stocks. And also, we have a special kind of stocks that we refer to as exchange-traded funds or ETFs. So an example, we have the iShares ETF here. So this is the Global Clean Energy ETF, and it's basically a basket of stocks combined together to track the performance of an index. So remember, an index will be basically a weighted average of several stocks trading in a particular market. So we have the Nairobi Securities Exchange Index. In the US, we have the S&P 500 Index, we have the NASDAQ 100 Index, the Dow Jones 30 Index, and so on. So when you look at the S&P 500, if you want to participate in that market and get the benefits of investing in those 500 companies, you don't buy the index, it's more preferable to buy the ETF. So the exchange-traded fund can easily track the performance of those assets with a very high accuracy. So if the S&P 500 index is up 30% in a year, then the investors in the S&P 500 ETF get to realize the similar return. So we have the iShares Global Clean Energy ETF here. Another example here is the Saudi ETF. So you can see how it has been performing. So it's one of the best ways to create longer term wealth. So for investors who are looking, let's say, to invest in the stock market with a longer time frame in view, let's say you want to build a position for the next 20, 30 years, then the best way to do this is by going through an ETF. So we just keep on building your investment amounts. So this month you might come buy 100 shares, next month you buy 200 shares, and you keep building that position. Then over time, you realize that you can compound your gains over time and make some pretty good returns. So this doesn't require active management. So unlike stocks, where you have to do analysis, identify the stocks that are doing well, rebalance your portfolio, sell some stocks, buy some others. For the ETF, since it combines the entire market or the selection of stocks within a particular index, then you just keep on building your positions within that index, and then you track the performance of that index over time. So a majority of the ETF investors tend to be long-term, and they are looking to outperform the short-term traders because they have the advantage of the time in the market, not timing the market. So you can trade ETFs. They have a similar kind of description. So for instance, if I go to the specification here, if you buy one contract, you're buying basically one share. So what else? Tick size is 1 cent, that is 0.01. trading hours, they're same as the stocks. So nothing much. Swap, long, swap short, kind of a similar thing. And also the 3-day swaps apply on Friday. So now we move on to the next asset, and this is commodities. So we have a lot of commodities available for trading. One of the most popular commodities on our platform is gold. So you're able to trade gold on the platform. So this is the chart for gold. So the symbol for gold is XAUUSD. You trade it very similar to a currency pair. So the current price of gold is 1758.03. So you also might want to notice that the specification here, if you trade one contract in gold, you realize that the contract size is 100. So by buying one contract, you'll be buying 100 ounces of gold. So in this case, gold is not traded in carats. In this sense, it's traded in ounces. So if you buy one contract, you'll be buying 100 units of that gold, and the price of one unit is 1788.06 here. So it's a live price which will keep on changing. So if you decide to execute a trade in gold, I'll show you. It's very similar to when you're trading, let's say, Euro USD or even Pound USD. So you just go to new order, identify the number of contracts you want to trade. That's one contract. So 100 units of gold, buy by market. And now you notice that the amount in points is also the same as the amount in dollars. So if you buy gold, one full contract, if you are at negative 52, then it basically means that you're negative dollars. Negative 45, negative 45, and the positive side is also the same. So at the same time, if you decide to trade a much smaller size, then it applies the same way as currencies. So if you, let's say, decide to trade 0.01, which is the minimum contract. If you're a beginner trader and you decide to trade gold, I advise you start with a very small lot size. Gold can be very volatile, meaning a larger opportunity as well as a larger risk. So now if you trade 0.01, notice that 43 points are worth 0.43 of a dollar. So it's a much lower risk. And in this case, you're able to hold on to a position for longer and survive the volatility if you decide to hold on to such a trade. So that's it for gold. We also have oil. We have coffee, we have cotton, we have cocoa. All these are tradable in a very similar manner. So I just want to look at oil, which is also very commonly traded on the platform. So I'll start with Brent oil. Almost say Brentford. So this is it. This is a UK oil. The current price is $95.440. So the specification here is quite similar, only that the standard contract size is also a little bit different. So if you go to specification, you'll notice that one contract in oil is basically 1,000 units of oil. And remember, we trade oil in barrels. So this is 1,000 barrels of oil. So the price you see here is the price of 1 barrel, but when you execute a trade of one contract, then you're basically trading 1,000 barrels of oil. So the application is very similar when you are trading currencies or even gold. So if, let's say, you go here and execute a trade, and then you set up a volume of 1, you're trading 1,000 barrels of UK oil, let's say by market, and now it is 50 points, $50, 48 points, $48. So similar application with what you have seen in gold and also in Euro USD, Pound USD, and so on. So the next asset is available for trading. No, our time is running out quick. Is stock market indices. So there is quite a large number of offering involving indices. So before I move further, I'd like to mention that all these assets are verifiable. So you can always check the particular asset you want to trade and see the trading hours and all the specification. So it's not something special that I'm doing that you don't be able to access. So if, for instance, you want to check, I want to show you gold. Yes, here is gold. So if you go to specification, you need to just check the sessions. You'll notice that gold opens 1 hour later after forex. So forex opens literally at midnight on Monday. Gold will open at 1 a.m. on Monday, and then trade the same way for 24 hours. Close on Friday at midnight, and that's it. That's the major difference between the sessions in currencies and commodities. So now, when it comes to trading stock market indices, I would like to mention that we have the index for Hong Kong, we have China, India, we have Singapore. We also have German indices, Spanish, French, UK, and also the US Dow Jones. We have the dollar index. This basically tracks the strength of the dollar against other currencies. So we also have the dollar index futures. We have the US Tech 100, which is basically the NASDAQ 100. We have the volatility index. This tracks the volatility of the S&P 500, the Japanese 225 index. This is called the Nikkei 225 index, the Russell 2000 index. We have the S&P 500 index and so on. So for indices, they are majorly used as benchmarks to track the overall performance of a particular market within a selection of stocks. So for instance, if you look at the S&P 500, it basically tracks the performance of the top 500 companies in the US. So a quick illustration of how it does this, so just a moment. You can always try and use, let's say, the FinViz website. So if you go to the maps, they have a very nice map of the S&P 500. So this is the S&P 500 stocks. So some of the largest stocks in this particular market include Microsoft, Apple, Google, Meta is Facebook. You have Nvidia, Amazon, Tesla, Walmart, ExxonMobil, Chevron, J&J, Lilly, and so on, including this banking behemoth that is Berkshire Hathaway. So all the S&P 500 stocks are put set in one map here. So the weight that each stock carries in the index is indicated in the size of the rectangle or the square in this case. So you'll notice that some companies will have a higher weight, while others can have some very small amount of weight in the index. So if there's a big movement in Apple, it will have a significant contribution to the S&P 500 compared to a much smaller company, such as, let's say, HP Incorporated. So for the indices, they basically track the performance of the market. So by following an index, you're able to make assumptions about a particular market. So for instance, if you look at the one-day performance of the S&P 500, largely looks green in energy, Tesla here, Meta. So we might say that it's not very green. We also have here instances of a lot of red. So it's a mix of bull, bearish kind of performance today. So when the index is going up, it's indicative that the stock market is doing well. So the S&P 500 is often used as a benchmark to show how the US stock market is doing. So if the index is doing well, then the market is doing well. If it's bad, then it's bad. So for instance, if you look at the year-to-date performance, the performance of the S&P since the beginning of the year, you'll notice that the majority of the stocks are in the red, indicating that we're in a bear market, and things have not been cool, especially for most of these stocks in the red. So the only clear-cut sector that has experienced good growth is the energy sector, where a majority of these stocks are all in the green. Well, in other sectors, a little bit of mix of both. Healthcare is trying to do something. Healthcare brands something here. Utilities quite good. Consumer defensive. We have some companies in the green, while most of the other stocks are in the red. So that gives you an idea of what kind of information you get by looking at an index. So if you're looking at the S&P 500, this is how the index is performing. But then, if you want to look at individual companies in the index, you can check out the FinViz and see how that's performing. So for instance, for now, the market was extremely bullish before the last 3 hours started weakening and going towards the lower side. So when you're trading an index, let's say the S&P 500, And let's say you go to the specification, you notice it's kind of similar with shares. So the contract size is 1. So if you decide to trade on volume 1, you're buying 1 share at this price. Remember, you have leverage on your side. So swap long, swap short, similar 3-day swaps on Friday, and also if you look at the session, the market opens at 1 a.m. and this is on Monday, runs through midnight just like the currencies, and keeps on doing that up until Friday midnight. So the key distinction between indices and stocks is that indices are tradable in a public market. They are not traded on a centralized market. And in that case, you're able to trade them for 24 hours a day. So indices will trade for 24 hours a day, while stocks and ETFs will trade a much smaller window within a day. So I believe that is mentioned, and hopefully there's no other asset that I've left, but you all get the idea. So for any particular asset that you want to trade, you find it's on the platform and you don't know the details about that asset, just click on it. Let's say Tesla, go to specification, look at the details for that asset, and if they are good for you and for your trading needs, then you definitely go ahead, deposit money, execute a new order, decide the number of assets you want to trade. Let's say you want to buy 3 shares here. Let's say you want to buy 3 shares of Tesla. So go to new order, select 3, click buy by market, and that's it. You've bought your 3 shares of Tesla. You can click, hold and drag to set a stop loss. Let's say you want to sell your stock if it loses by a couple of dollars. So buying at 886, let's say you set a stop loss at 832. So you are basically telling the broker that if the price of this asset drops to this point, then I am not willing to engage in further losses, and they close the trade at that price level. And of course, you can do the same for the winning side. Click, hold and drag, set your take profit, something that we have done in the previous sessions. So price moves here to here, then automatically the broker sells the shares and adds the profit in your trading account balance. So it makes it a very simple way to participate in these global markets. So I know it has been a minute since I checked on the questions. So just a moment. So there's a good question here, which is the good way of trading between manual and robot. I wouldn't say there's a good and bad way. If you have a robot and it's working and it's profitable, then by any means, I'll go for the robot because it relieves me of the labor. But then, if you're not conversant with how robots work and you are not conversant with trading, then you might want to learn a lot of manual trading first before you go for the robot side. So I would say learn first, understand how it works, then you'll be in a position to compare between manual trading and robot trading. So best strategy for a long-term investor who can't be trading daily, find a very nice ETF, exchange traded fund, and then keep pumping money into that ETF. Especially right now when we are in a bear market, it would be a very nice place to find an ETF with low valuations. One of the most popularly traded ETFs is the S&P 500 ETF because it tracks the 500 biggest companies in the index. So you can have multiple. You don't have to just build into one ETF. So you can do something on, let's say, energy. You can do something on semiconductors, whatever your affiliation is or whatever you understand in the market. Study that, identify an edge, then keep pumping money into that ETF. So it's not a one-day process where you deposit money and then you leave it for 10 years. If you have that money, that would still be good for you. But then, if you want to build a position over a longer period of time, then the best asset for you to look into, do further research, is the ETFs available in the market. They are different, so different ETFs will give you different exposures. So good question, and the best asset for the above. I cannot recommend a trade, so kindly bear with me. According to policies that I work with, I cannot recommend a trade. I will not recommend an asset. So that's why I'm saying that yes, ETFs are the best long-term investment, but then you have to do your own research and then identify the right ETF for you. So there's a good question. Great job here. I'm here curious on taxes on profits and prepping. Does this platform help give you a rough idea? Are there capital gains taxes? So for us as a financial markets broker, we do not interfere in any way with your tax and also the tax authority. So if you deposit money with us and trade in the financial markets, if you make a profit and then you withdraw your profit, it's 100% your responsibility to report to the KRA how much you've made and then submit the relevant tax. So we don't get involved. Thank you for the question, Derito, and thank you for the question, Joseph. Very engaging. So I'm just checking, make sure that I've gone through the entire list. I know our time is almost up. Actually, our time is up. So we have seen stocks, we have seen indices, commodities, currencies. So anything else? We have seen exchange traded funds. So hopefully that will give a clarification on the assets available for trading on the platform. So at a future date, we might have more assets available for trading. And if there's a specific stock or ETF that you'd like to trade, and you check on the platform and you realize it's not there, you can always request with us and we'll do further follow-up and make sure that that asset is available for you for trading. So at the same time, maybe in a future date when the regulations are much better, we might have crypto products. We will add them on the platform, Bitcoin and many other cryptocurrencies available for trading. So when things go down well, we might have these in the future. And they will also be available for trading in a very similar manner with the assets that we have mentioned here. So the fact or the point of today is that nothing is hidden, everything is very transparent, including all the trading fees that you pay for your trades. So you can always, like Craig, go to the specification and check for each individual asset. So now that we are through with today's session, I would like to thank everyone for taking the time. For those who are new, make sure that you go through episode 1 and 2, where we covered the introduction. We covered charting skills. Today we have covered tradable assets. And on the next session, we'll be focusing more on candlesticks. So a good question, what is the difference between the indices and index? So the plural of an index is indices. So when you basically say indices, you're looking at many index. So I'm hoping that clarifies things. So thank you very much, guys. Thank you for your time and thank you for your participation. I'm hoping that now you understand the assets available for trading. I encourage you to do a lot of practice from now onwards. So if you just started and went through the first and the second episode, now from the third episode, I demand that you do a lot of practice on your demo account. Practice as much as you can, execute trades in currencies, stocks, indices, ETFs, commodities. Experiment with all these products. It will not cost you much. It will only help you in understanding this platform further, getting conversant with the platform, and it will make it easier for you now to transition to a live trading account. So by the time we get to the 10th episode and we are looking at trading like a pro, you will have understood all those concepts, practiced, internalized, got the skill, and now it will be easy for you to start trading. So for now, at this level of the series, I encourage you to download the trading application and start trading. And that is specifically on your demo account. And once you are through with this, eventually you get to your live account and start trading with real life dollars. So thank you guys. See you on the next session.